The JP Morgan Premium Income ETF, known as JEPI, has been one of my favorite vehicles to buy into and generate a nice juicy dividend on a monthly basis. Now, the high starting dividend yield that JEPI offers and the potential for capital appreciation, as well as the option overlay to limit downside risk, are a few of the reasons on why this covered call ETF has exploded in popularity, and definitely partially the reason on why I currently own well over 1,000 shares. But some smaller investors that are interested in this ETF are curious on what the real returns and dividends will look like long into the future if they were to purchase just a small amount of JEPI on a consistent basis. Now, in this video, we're going to dig deep into the JEPI ETF and see all that it has to offer, as well as calculate the exact amount an investor would receive in monthly dividend income if they were to purchase just $25 of JEPI on a daily basis over the next 30 years straight. Now stay tuned because we are going to go through all this and more, but after you please drop a like in this video and subscribe for more future content like this. Now before we go over the exact math and show you exactly what the future would look like for an investor that invests a relative small amount of just $25 a day consistently into the JEPI ETF, let's first learn a little bit more about the JEPI ETF, how it works, and what it has to offer. Now heading right over here to the JP Morgan website, it says seeking consistent premium income with lower volatility. JP Morgan Equity Premium Income ETF seeks to deliver monthly distributable income and equity market exposure with less volatility. The expertise is that the portfolio managers have over 60 years of combined experience investing in equities and equity derivatives. The portfolio, defensive equity portfolio, employs a time-tested, bottom-up fundamental research process with stock selection based on our proprietary risk-adjusted stock rankings. Disciplined option overlay implements written out of the money S&P 500 index call options to generate distributable monthly income. This strategy involves selling call options on the stocks in the portfolio in exchange for the premiums. Now, in a covered call strategy, the ETF purchases the underlying stocks and simultaneously sells call options on those stocks with strike prices that are higher than the current market price. By doing this, the ETF generates additional income from the premiums received from the call options, which can help to boost the overall yield for the ETF. However, there is a downside to this, and this is something investors should be wary of. If the stocks in the portfolio happen to rise above the strike price of the call options, the ETF would have to sell those stocks at a lower price than what they would have potentially been able to sell without a covered call strategy. So with the covered call strategy, simply put, you're basically offering the buyer of the call to buy the shares at a set determined price on or before an expiration date. And with this strategy, a lot of times it can work out just fine, but if the market happens to really start to run, there could definitely be a situation where you could have made more money without selling the covered call. And if this were to happen, of course, it would mean that the ETF could miss out on some capital appreciation potential of those stocks, which could also potentially limit the overall growth of the fund. Now, the other side of this covered call theory is, of course, downside protection. When you sell a covered call and you're paid the premium instantly, that more or less lowers your cost basis and or gives you some downside protection. So in the case of the market trading sideways and or down a little bit, the covered call strategy could be a great asset to the portfolio. Now, the result of this, at least so far, has provided an attractive 12-month rolling dividend yield of around 11.45% and an SEC 30-day yield of 9.59%. And for all this, JEPI has an expense ratio of 0.35, which is definitely competitively priced compared to the peers and other covered call funds similar to this. Now, other than the option overlay, JEPI has some very solid holdings, the top 10 holdings being things like Adobe, Amazon, Microsoft, MasterCard, Comcast, Visa, Accenture, Pepsi, Intuit, and Costco. Now, looking at JEPI's holding breakdowns, the fund is pretty well diversified and does have a little bit of everything. Technology being 17% of the fund, industrials 13%, healthcare 12%, consumer defensive 12%, financials 12%, consumer cyclical 9%, utilities 5%, communication 5%, real estate 3%, basic material 3%, and energy around 2%. Corporate bonds or other around 13% and 1%. Now keep in mind, with JEPI's breakdowns, the fund is set up to have some possible potential capital appreciation, but with the underlying holdings and the option overlay that's employed, the fund most likely is not going to shoot up as far as ETF price anytime soon. But for more income-focused conservative investors that want to earn a nice, sustainable, long-term dividend and have some potential capital appreciation, JEPI could be a great option. But to look a little bit deeper into JEPI's price, it's currently trading at $55.42, closer to the higher end of the 52-week range at $57.89. The 52-week range low, $49.92, so JEPI was much cheaper not all that long ago. Year to date, the fund is up 1.73%, over the last year up around 1%, and since inception, JEPI is actually up 8.24%, which actually isn't horrible, considering most of the higher yielding covered call ETFs have performed pretty horrible as far as ETF price historically. Take QYLD for an example. A fund that has sort of a similar strategy is down 28.9% on the max time frame. So all in all, with JEPI's massive dividend, the ETF has performed pretty well. And speaking of massive dividend, looking at JEPI's current dividend yield, it's at 10.44% trailing 12 month. So investors that get into JEPI now could be receiving around 10% just from the dividends depending on how the market trades right off the bat. JEPI also pays a monthly dividend. And although the monthly dividend is sort of all over the place, because again, the fund strategy and the distribution depending heavily on how the market performs on an ongoing basis. The ETF's distribution monthly is going to change quite a bit, but overall, JEPI has been paying around 30 to maybe 60 cents per share on a monthly basis since inception. And also, it's important to keep in mind that even if JEPI was to pay a consistent 36-cent monthly distribution, which is on the lower end of the last various distributions, that still will give investors a pretty decent yield, somewhere around 7% on a yearly basis. So now let's get into the interesting part. If an investor with a relatively small amount of money on an ongoing basis was to invest around $25 per day into the JEPI ETF every single day of the year, which equals $9,125 per year contributed, how much would this investor be earning over time and especially long-term into the future? Let's check it out. So for the dividend calculator, we typed in monthly distribution, drip turned on, which means all the dividends are going to be reinvested, a $25 starting principal, $91.25, a 10.44% annual dividend yield, 0% annual increase, and around a 1% annual share price appreciation for 30 years. Let's go ahead and take a look. So here we have it. Keep in mind, this is just off of a $25 investment on a daily basis, which after year number 1, this investor would be earning around $2.74 in dividends. Year number 2, after the big contribution, this investor would already be up to around $1,000 in annual dividends. Year number 3, almost $2,000 a year in dividends. Year number 4, almost $3,000. Year number 5, almost $4,500. Year number 6, this investor would have almost a $55,000 portfolio and over $5,800 a year in dividends. Now skipping right ahead, if this investor were to keep doing this for 10 years, let's say, just $25 a day, this investor would already be up to $12,000 in annual dividends per year, over $1,000 in dividends per month. Now 15 years in, almost $250,000 in principal and over $23,000 per year in dividends. By year number 20, this investor would have over $430,000 invested and over $38,000 in annual dividends. By year number 25, this investor would have over $700,000 in JEPI and over $60,000 per year in dividends. And all the way down the end, if this investor was to invest $25 a day, reinvest all the dividends, and just keep doing this for 30 years straight, this investor could potentially have over $1 million in JEPI and almost $88,000 to $90,000 in annual dividends paid. So there we have it. There's all that the JEPI ETF has to offer as of right now, and how much a relatively small investor could see in the future after investing a consistent $25 per day over a long-term consistent basis. But I want to hear what you guys think down below. When it comes to the JP Morgan Equity Premium Income ETF, is this an ETF that you've been buying as of recently, or is there a better covered call ETF that you want me to look into? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks for stopping by, and I'll see you in the next one.